Hi, guys. Welcome back to The Big Picture. I'm Joe at Paradigm, your 10,000-foot view into the crypto options market, joined by Marty, crypto vol guru and crypto Twitter phenom, as well as Greg Magadini, our options data expert from Amber Data. And today, we are very excited to welcome on Dennis Ehlert, a crypto derivatives trader at SEBA Bank in Zug, the crypto valley of Switzerland. So for those of you who don't know, SEBA is a Swiss-regulated bank for managing, investing, and storing digital assets. But Dennis knows a lot more about SEBA than I do, so I'm going to let him introduce himself, tell us how he got into digital assets, and what he's currently doing at SEBA. Dennis, take it away, man.
Thanks, Joey. My name's Dennis. I work at a option trader at SEBA Bank. Here we offer option OTC liquidity for crypto options to our clients in Switzerland. I've been with SEBA for a bit more than 2 years now. I come from the traditional finance, as many of you as well. Worked as a portfolio manager for multi-asset funds for 8 years around, and landed in crypto around in 2017-18, and wanted to dive deeper into it. That's why I moved on to SEBA.
Oh, amazing. Okay, awesome. Yeah, thanks for that intro. And kind of as you said, everybody here kind of has some sort of TradFi background, except Marty. Marty, you've always been you're probably the most crypto native here, right?
Yeah, I don't want to age myself, too much, but I'm a 90s baby, right? So I was, I'm just crypto born into the internet. I came out holding like a Game Boy out the womb, so this is my first financial gig is in the crypto space.
Yeah. Okay, awesome. So I guess we'll jump into it. I mean, we haven't recorded in, 10 days or so. So obviously a lot has happened. And I think in the crypto option space, the most interesting thing to me is this Bitcoin versus Ethereum vol relationship that has just completely flipped. So if you're a new viewer, maybe you're not paying attention as much to this, to give you a little bit of background and context, since the start of the year, the Ethereum minus BTC implied volatility spread has pretty much just generally trended lower throughout the year, aside from a couple spikes here and there. But this Ethereum versus BTC vol spread has persistently traded flat to negative for most of the year. So what that means is Ethereum vols have been trading under Bitcoin vols. And naturally, the low ETH vols relative to Bitcoin coincided with this massive overwriting activity that we've seen occur on Deribit since the start of the year that has put consistent pressure on ETH implied vols. And just a little bit more background, this flow showed up after Ethereum's transition from proof of work to proof of stake, and especially after the post-Shanghai upgrade, where ETH has increasingly transformed into this yield asset, which has warranted more vol supply. People stake, earn yield, but then they'll also sell calls and earn more yield. And so you guys can see on this chart on the left where the spread has been negative, but then look at that arrow. Over the past couple weeks, this spread has completely reversed. So I guess I'll just open it up, either Dennis or Greg. What do you guys make of this spread flipping to BTC implied vols now trading under Ethereum vols?
Greg, you want to kick it off for?
Yeah, sure. I'm happy to. One of the, like you said, Joe, what we saw since the Shanghai upgrade is that consistent overwriter supply. And now we actually have a catalyst with the BlackRock ETF filing for ETH vol to start to pick up. And it's very interesting. ETH has a third of the market cap of Bitcoin. Theoretically, it takes less money to move it around. Historically, small cap stocks are more volatile than large cap stocks. This is sort of the natural relationship. And everyone's been stocking this for a while, and I think we got the catalyst.
Yeah, I think that makes sense. Dennis, how about you?
Yeah, I agree with Greg. I mean, the news on the BlackRock ETF definitely kicked it off, kicked it off the flipping, so to say. Ethereum vols and liquidity, I think, have a lot to catch up versus BTC. So it's a higher beta market, and it's in general just, I think, also the ongoing story about the BTC ETF. When is it finally going to be approved? When when is the next chapter starting for BTC? Because this narrative has been going on for months now. And I think investors are just getting excited about something else, and we're basically waiting for something to initiate that trade or that catch up, and that ETF is definitely one of those stories.
And it's funny. I mean, you saw like the epitome of this yesterday, where like now you're seeing people like take advantage of this. I mean, look at the XRP fake pump and dump story, right? That gets listed, all these shorts get completely wiped out. Oh, Ripple ETF coming. I remember seeing that. I'm like, what the hell? We're way too soon for this. But then obviously it turns out fake, and I think it was the block again that did that. Nothing gets lost.
It's all
I mean, Jesus. But yeah, that's a conversation for another day. But so yes, I agree with you guys on the Ethereum ETF news, but kind of just looking more like structurally at the ETH fall market as well. I think it's pretty interesting what we were like when we look at this spread and we see it moving back into positive territory kind of late October. Well, this is kind of coinciding as well with this overwriter who's effectively been forced to unwind a lot of their risk in October because of this new Deribit Vega margin thresholds of 400k Vega. So once your portfolio exceeds short 400k Vega, your maintenance margin requirements get a bit stricter. So, were they forced to unwind? No, but given the fact that these guys probably don't want to pay an insane amount more margin, they probably, especially, Ethereum spot and vols were rallying as well, their Vega was expanding, decided to unwind their risk. So given the size of their outstanding risk, this entity in October bought back over 1 million Vega last month, over 1 million Vega. I think it's closer to 1.5 million Vega. And number two, on a go-forward basis now, there is less likely overwriter supply in Ethereum going forward from this massive entity that has just continued to weigh on the curve. Unless this guy wants to pay more maintenance margin, we'll see. We'll see how much Deribit actually enforces this as well. And then number three, as you guys said, you have these Ethereum ETF green shoots that are finally leading to some spot and realized outperformance. So taking it all together of, the ETH narrative getting a bit better, and then now this overwriter covering their risk, there being less overwriting supply going forward, I think it kind of makes sense, that Ethereum BTC vol spread has flipped from negative back into positive territory. So in a couple weeks, just looking at this chart, the Ethereum BTC 1 month at the money vol spread has moved from -10 now up to around six vols at the time of recording. And funny enough, we saw a large trade in this spread yesterday where somebody bought 800 of the BTC December 1st, 37,000 straddles and sold 15,000 of the Ethereum December 1st, 2150 straddles. So perhaps playing for a continuation of this spread to move into positive territory. I mean, I haven't seen many trades like this in large size that clearly look like some sort of BTC versus Ethereum vol spreads trade in quite big size. But I mean, Marty, what do you think about this spread? Is this, I know you've kind of, looked at reversion trades, especially kind of in the short vol sphere, but is this a reversion trade to be selling Ethereum and buying BTC with like this? Because when you look at the quote unquote percentiles, yes, things are dislocated, but it's dislocated for a reason. Or do you think this trade makes sense?
Yeah, it makes sense. We'll see how it all plays out, right? My left curve thought that I've been kind of following is I've been watching the relationship of default Bitcoin and ETH, and then I've also been watching the 30-day rolling correlation of ETH BTC. And you saw ETH BTC fall down, I don't know, like 0.052. And my left curve thought that I've been watching is the Bitcoin ETH devol. And right now, devol ETH is higher, a few handles higher. And then my other thing that I've been watching was the ETH BTC pair and watching that in absolute free fall. And then watching all my OTC chats ping up of people putting on some binary options for like 10x payoffs. And I was like, I think it's just time to buy some ETH. And then that was my trade that I put on. I didn't end up taking this ETH BTC vol spread trade. I was just playing ETH outright.
Yeah, I think that makes sense. I mean, you see how much this spread can move in the matter of days, right? So, potentially a tough one to risk manage. But Greg, so I think you have some charts for us today. Is that correct?
Yes.
Okay, should I start here?
Next chart. There we go. Perfect.
Cool.
Back one chart.
Sorry.
And Dennis, feel free to jump in if you have any thoughts around this. So one of the things that we're looking at, I think is very interesting, is just sort of the volatility of the term structure, especially in the front end. So we're at a pretty flat term structure year to date, sort of the upper 80th percentile. But what we see here in this chart is we see a clear kink in the January expiration. So that's really, the ETF deadline theoretically happens during the January expiration cycle. The way that options traders are positioned is long sort of that contract, but option traders are also positioned long, shorter in the front end, expecting some sort of news any day now. Do you mind jumping to the next slide?
Yep, got you.
So what we see here is we'll see sort of the volatility of the front end. So this is a 5-day time lapse. So we can see the blue line is the term structure now, and then we can see it 5 days ago. And so when there's sort of this excitement, we had a nice pop last week. The front end is just quick to bid up vol. And so I think what we're seeing here is that although most people are positioned for the January expiration, traders are willing to pay a premium to be long right now, expecting some sort of early release of the news catalyst of a spot ETF. Do you mind just jumping to the next slide real quick?
Got you.
And so what we really see here is the variance risk premium. So the variance risk premium is relatively high since the Bitcoin rally that we saw at the end of October last month. And so it's been consistently high. So traders are willing to bleed a lot of, call it, 15 points of vol premium just to have that exposure. And so I think that's very telling as far as how the option market is positioned, that we're expecting something to happen earlier than the January expiration cycle.
I believe that this is going to, or has already been attracting vol sellers back into the market as well. This is just, I think, given that we are in BTC, for example, we are approaching now, there's like this current time window of a possible or pending applications that they can be approved. But once this is out of the room, I think, and Bitcoin has basically no new narrative around to continue its bull run. I believe the vol sellers are going to reappear in the market. I think, as far as I can see on the screens, vol selling has already appeared. IVs have sort of topped out for now, and I believe that this risk premium is going to be compressed and going forward in the next weeks if there is nothing new coming in.
Yeah, Dennis, I think that's a really interesting point. Joe, do you mind going to the next slide?
Yep, sure.
So Dennis, to your point, I think something that's really interesting on sort of the vol selling side is if we look at sort of the curvature of, say, the December expiration or the November 24th expiration, like we have a really interesting opportunity for risk reversals. So because everyone got long sort of call side vol, you have essentially a flat put skew between 25 delta puts and at the money vol, and then a pretty elevated 25 delta call skew. So that's a pretty interesting place to essentially sell vol on the call side, buy it on the put side. And if we get any sort of normalization, you can have a delta hedged risk reversal position with a net credit. And that's a way to get short that vol, gives you a pretty wide window of a range movement, and essentially takes the other side of that FOMO flow on the call side. So I definitely think there's a good argument to be made for that.
I got a question for you, Dennis. Do you think that this, let's say ETFs, spot ETFs, are something that people actually want to trade? Because my whole theory here is, let's say we get it, we're building up all this hopium into these events, and then we just get a vol crush because nobody actually wants to trade it. The AUM of the Canada, I guess it's the 3IQ and some other spot ETFs are like just over $1 billion, and you're not really seeing that much interest in these products. Of course, a spot ETF is better than a BITO product that Greg had mentioned, but do you think that people actually want to trade these products or are we just coming into a vol crush event and some hopium?
I mean, there's always a risk that and expectations are very high at the moment for these ETF. Basically, the whole story at the moment, the whole price movement is based on the success of these ETFs coming rather sooner than later. I think the ETFs you were referring to are the Canadian ETFs, right? And
Yeah,
that
3IQ.
Yeah, so that's like that $1 billion volume in there. I mean, America definitely has a higher volume when it comes to there's more investors, there's more potential. So I wouldn't say like because there's little demand in these Canadian ETFs, there won't be any demand in US ETFs. There's a different market, a much bigger market. But even if you use that relative volume of that 1 billion to the total outstanding market volume, it would still mean, I think I read that too, and I think it would mean like a 20, 23, 25 billion inflow in those ETFs if you keep those ratios of the Canadian ETF to the Canadian market in total. So there is definitely, I think there will be demand. It's just because there is a lot of talking going on, and I'm a little bit, every day you read and you hear for months now, and I can't wait for the next story, to be honest, to come, and I hope that the story will settle soon and the crypto market can move on forward then. But I think that the ETF will definitely have a rather positive than negative impact.
Sure, yeah. I know Greg and I are waiting on options on these spot ETFs, and I'm all for having more products to trade and more tools in the toolbox, and allowing people to access these products in any market will be especially in a regulated manner, will be a good thing.
And Marty, I know this is anecdotal, but as far as using the Canadian ETF as a proxy for the US spot ETF, I'm a Canadian and I've never traded a Canadian equity in my life.
Exactly. Yeah, my family's in Toronto, and I'm like, do you guys even know that this product exists? And they're like, no, we only know about maple syrup futures,
So every now and then, I think it's important on our podcast to have on guests that are a bit more in touch with the regulated environment in their respective jurisdictions. And, crypto regulation in Europe, especially because I'm moving there, is something that's becoming increasingly prevalent for myself selfishly. So I wanted to, ask Dennis, so SEBA is a fully regulated crypto bank. So I'd be interested to hear how the Swiss regulatory framework supports the crypto space and what advantages that it offers both your bank and investors.
Yeah, sure, Joy. So Switzerland was really one of the first nations that entered the crypto market or that got exposed to cryptocurrencies, or besides Singapore and then Japan. There was in 2014. It started in 2014 with a Federal Council's paper on virtual currencies. About that time, like a year and 2 years before that, trading cryptocurrencies, the business in digital assets in general emerged, and out of that report was generated. So this was the first step in. It was actually also the time when the Ethereum Foundation settled here in Zug in 2014, also because of the reasons of a starting regulatory framework. 4 years later, then in 2018, they categorized digital assets within a regulatory framework governing ICOs. So from that point on, basically, asset tokens, payment tokens, and utility tokens were clearly defined. So that added an extra layer of clarity on that point. A year later, in 2019, FINMA issued guidelines on stablecoins, because that was a point that also caught attention in the market. And last but not least, in 2021, there was a major step towards the complete regulatory framework for digital assets with the DLT bill that was issued in 2021. And that DLT bill, basically, what it did was it recognized distributed ledger technologies as a electronic register of rights. So that was one point. And the next point was that it allowed DLT-based trading, custody, settlement, and clearing of securities. So from that point on, there was full regulatory clarity of dealing with digital assets in Switzerland, and that helped businesses that settled here in Switzerland to understand that framework and the activities they were planning to go into. So that was the regulatory part of it. Basically, it supported massively companies dealing with blockchain technology and distributed ledger technology to settle here. And the other point is, which I think is also very important and helpful, is that FINMA, so the Swiss regulator, maintains an open dialogue with the industry here in Switzerland. So they are really trying to help and understand better the needs of the business to further grow, and therefore also help to advance these technological revolution, basically, that comes with the blockchain technology. So that's an important factor, that open dialogue that FINMA keeps. That's basically why it is also the reason why between Zurich and Zug, for example, more than 1,000 companies dealing with digital assets or blockchain technology are settled here now. Zug is known to be named as the Crypto Valley. The fact that the regulatory framework in Switzerland is set and well articulated makes it such an attractive place to settle for companies such like as SEBA Bank, for example. And from a client perspective, like, this is now basically the framework that FINMA offers companies such as SEBA. But from a client perspective, there's also a lot of advantages that Switzerland offers. I mean, there's legal clarity. It gives just clients a sense of security and assurance when knowing they're dealing with a regulated entity. We have high compliance standards here in Switzerland, or we are reducing the risk of fraud and malfeasance. So that helps. Is another layer of protection for our clients here in Switzerland. Also on these underlying. So there are a bunch of advantages that a regulated entity can offer compared to non-regulated entities. And of course, this stability and reliability factor. Your clients who are maybe new to the crypto business are entering a very volatile market from their perspective, and so they're already dealing with high vols. And what they are looking for is a regulated institution that offers them some sort of reassurance, basically, and security as an added layer, an additional safety layer for them.
Kind of just digging into the structured product stuff a little bit more, just because I know Marty's an expert on this stuff as well. Like, why is Switzerland such a popular structured product?
Yeah, sure. I mean, Switzerland is as you say, is famous for its structured product markets. It's regulated by FINMA, which definitely helped to promote it. Switzerland has a favorable regulatory framework around the structured product market. It creates a level of investor protection and transparency, for the issuer, but also for the investor. So that is one point. Then the next point that you also mentioned is the wealth management part. Or Switzerland has a high concentration of high net worth individuals who tend to seek capital protection or tax efficiency, and the structured product market offers both to them. Basically, that's definitely an advantage, and that's why it got so popular in Switzerland.
Mm-hmm. That makes sense. And in terms of the optionality that's currently being wrapped into the structured products? I know we can't talk specifics here, but are we talking vanilla options? Are we talking some barrier options, or things like that? Digitals.
Yeah. So overall, the structured product market on crypto has taken quite a beat since 2020. I think I read in a study that volumes have gone down by more than 90% over the last 3 years in structured products. Most of the action is happening in ETPs, by far the most favorable, most popular products to invest in for clients. Structured products themselves are more focused on plain vanilla options, using plain vanilla options. So capital protective notes. Then coming back to also the points I mentioned before of tax efficiency and capital protection. So the dual currency certificates, for example, those are two popular examples of structured products within the crypto, having the crypto as an underlying, that are used for that. Exotics, I think it's a bit early. There is definitely demand for exotics in the market, also in Switzerland. My personal opinion is that we are a bit too early yet, especially for the big institutions to step in, as the market is still cautious on the underlying itself. In many, talking about pension funds, talking about insurance companies, there is still a high level of cautiousness. So I wouldn't go too fast and offer them structured products and exotics right away, because it's just, in my understanding, a bit too early. I looked it up because I was interested in and seeing and looking how long it took for the equity market or the traditional market to offer structured product compared to when the equity, the exchanges open. It was about 100 years, I think it took. So between, I think equities started trading in the 19th century, and then almost like 100 years later, structured products were entered the market. I'm not saying it will take that long. I hope not.
Well, I'll be dead.
Yeah, I hope not. Of course, there's a lot more knowledge, a lot more technology, but still, I think this is a market that is definitely worth looking into it, and exploring it. But institutional adoption for these sort of products, in my opinion, we're not there yet. The ETF and the institute or the mass adoption will definitely support it, but as of now, more the easier structured products like CPNs and the DCCs is the preferred vehicle, I would say.
That makes sense. Marty, you're a big structured product guy. Do you generally agree with that view? Do you think the structured product market is going to come along a little bit faster? I remember we had Bybit on, and they're offering OTC structured products. I forget exactly what the structure was, but it seems like you're pretty in touch with this world.
Yeah, they do. Well, I guess that leads into a few questions and some comments. So some background story. I live down in Brazil. We have a full regulatory framework. We have clear tax laws, similar to Switzerland. But what you're running into is a lot of institutional clients, let's say treasury managers, banks, family offices that don't have money offshore. They can't go and onboard with you guys, or they can't go and put their money on an exchange that's offshore. It has to be a Brazil operating company, and there's just not that many players doing structured products here. I'm wondering if that's the same in Switzerland, because you are regulated in Switzerland. You do offer the products in Switzerland. Are you just seeing that your clients are more comfortable, putting capital with you guys versus on an exchange? Because I know Bybit, OKX, and others do the same similar vanilla options, but also maybe they're not giving the best pricing.
Yeah, sure. In our case, you also have to look at the full picture. It's not just the OTC trading, the option trading that we offer. Many of our clients are coming for other services like the custody solution, the lending and staking solutions, or the asset management part of it. So Some of them are using basically our offerings, our pillars. They are using the option trading as an add-on. Classic example is the overrider. We have clients in here in Switzerland that are rich in coins, and they want to use their coins somehow, and they override calls to generate some yield. Basically, I mean that's a classic example. So I would not say there is demand, but it's more coming from the smaller entities. I would say it's more the family offices, more the individuals than the big institutions that are jumping on that topic.
Yeah, we're seeing the same here, and it just comes down to like a onboarding and a regulatory framework. Like some of the biggest guys can only onboard with, let's say, Coinbase, right? And Coinbase only has 5 coins or something. You know, like there's not these stricter products, or even sometimes they don't even have access to derivatives. It's just absolute spot trade.
Okay, fantastic. That was a great discussion. I think we leave it there. We covered a lot, from ETH BTC vol spreads, ETF, to the Swiss regulatory environment, to structured products. So that was a great episode. Dennis, thanks so much for coming on, man. I really, really appreciate it. And maybe we do it again late in 2024 or something.
Glad to be back. Thank you for inviting me.